Welcome to Breaking News to Trading Moves. Today we're looking at the latest results from Microsoft's Q1 Fiscal 26. We want to break down the numbers they released and, maybe more importantly, explore who the author of this report sees as the winners and losers based on Microsoft's strategy and performance.
Yeah, it's a really telling situation right now in tech.
Yeah.
Microsoft put up some great growth numbers, especially in cloud, but almost immediately the conversation pivoted, didn't it? It went from revenue straight to the cost, the record spending needed to get that growth. So you immediately get this tension for investors looking at the ROI, the return on investment for all this AI infrastructure build out.
Right, that tension is really the core of it. So before we get into those market dynamics, let's just lay out the main numbers, the financial picture. For the quarter, Microsoft reported total revenue of $77.7 billion. That's up 18% year over year.
Strong top line.
And earnings per share, EPS, that landed around $3.70.
Yeah, solid numbers. Definitely shows that enterprise push to digital is still going strong. But, you always have to look a bit deeper than the headlines.
Exactly. And under the hood, the cloud business is really humming. Overall, Microsoft cloud revenue, that hit $49.1 billion. That's 26% growth there. But the real standout was Azure and the other cloud services.
That 40% number.
Yeah, 40% growth. That's the figure that really jumped out.
It absolutely did. But you've got to frame that growth with the capacity issue. Management basically said it out loud. Demand for AI and cloud is running ahead of what they can currently supply.
Ah, okay.
So to try and catch up, their capital expenditure, the Capex, what they spend on data center servers, all that hardware, it hit a record high. A record.
Wow. So spending more than ever just to keep up with the business they already have?
Precisely. And the guidance they gave suggests this heavy spending on the AI build-out isn't stopping anytime soon. It seems like it's going to continue. It's a big strategic signal, really. They're saying they'll spend whatever it takes to lead in this AI infrastructure layer.
And that explains why the market reacted a bit cautiously at first, even though the revenue beat expectations.
I think so, yes. The shares dipped a bit after hours, even with those strong numbers. It wasn't data about the demand, I don't think. It was more about the cost of fulfilling that demand. When capacity is tight and spending is at a record, well, investors start doing the math. When does the payoff justify this huge upfront investment? It's a bit of a balancing act they're watching.
Did they try to reassure investors? I saw something about returning cash.
They did. They returned $10.7 billion to shareholders through dividends and stock buybacks. That's pretty standard for a big tech company like them. Kind of signals, hey, we still have strong cash flow, even with all this spending.
Okay, so we have the numbers, we have the context, strong growth, but record spending to meet demand. Now we can look at how the report breaks down the market impact, who benefits and who faces challenges. Let's start with the winners.
Right. The winners are mostly the companies providing the picks and shovels, you could say, the stuff Microsoft needs for that record Capex.
Okay, first category listed is AI chips and server hardware. The report names NVIDIA, ticker NVDA, Advanced Micro Devices, AMD, Supermicrocomputer, SMCI, and Broadcom, AVGO.
Yeah, this makes a lot of sense. It's a direct consequence. If Microsoft says Azure growth is constrained by capacity, it means they need to buy a lot more specialized gear. So these companies, they're positioned perfectly. Microsoft's record spending means massive ongoing orders for GPUs from NVIDIA and AMD, networking gear from Broadcom, those AI servers from Supermicro. For Microsoft, spending isn't really optional if they want to stay ahead, and that's great news for these suppliers.
So the bottleneck at Microsoft actually fuels the order books for these hardware companies.
Got it.
What's the second group of winners?
The second group benefits more from what happens on the cloud. It's cloud data, analytics, and observability platforms. The companies mentioned are Snowflake, SNOW, MongoDB, MDB, and Datadog, DDOG.
Okay, these are companies dealing with data management, monitoring cloud apps. How does Microsoft's growth lift them specifically?
Well, think about it. Azure grows 40%, adding tons of new AI and Gen AI applications. All that activity generates enormous amounts of data, logs, metrics. These new apps often need specialized databases, maybe like MongoDB for flexibility or Snowflake for analytics. And then you absolutely need to monitor everything to make sure it works. That's where Datadog comes in. Their usage is often tied directly to how much cloud resources are being consumed. So as Azure grows, they grow too. It's like a multiplier effect.
It's the ecosystem playing out. Microsoft builds the infrastructure, and these companies provide essential services to make it useful and keep it running.
Exactly. They feed off each other. In a way.
And the last category of winners, you said it was maybe a bit more traditional.
Yeah, it's the Windows OEM ecosystem,
Mm.
specifically Dell Technologies, DELL, and HP Inc., HPQ.
Dell and HP, why are they seen as winners here?
Well, the report points to the fact that Windows OEM revenue actually went up. That suggests businesses are finally starting to refresh their PCs again, maybe buying slightly better machines, too. It's not just about replacing old computers. It could be about getting hardware that can handle newer AI features like Copilot, running locally.
Mm.
A healthier PC market directly helps the big OEMs like Dell and HP.
Okay, that covers the companies benefiting from Microsoft's push. Now let's look at the other side. Who faces headwinds? Which companies are categorized as losers because of Azure's strength and Microsoft's strategy?
Right, this side tells you where Microsoft might be gaining ground or applying pressure.
The first category is pretty direct. Public cloud rivals, Amazon, AMZN, and Alphabet GOGL are named.
Yes. I mean, when Azure posts 40% growth and talks about a really strong RPO that's remaining performance obligation, basically future contracted revenue, it sends a clear signal. Enterprises are making big long-term commitments to Azure. That definitely increases the competitive heat on Amazon Web Services and Google Cloud, especially when they're all fighting for those big, important enterprise AI deals. It's a battle for who hosts the future, really.
But isn't the whole cloud market still growing? Is it fair to call them losers if the pie itself is getting bigger?
That's a reasonable point. The report talks about headwinds, maybe not, total decline. I think the key is the rate at which Azure seems to be capturing these really valuable, cutting-edge AI workloads. If they're winning those disproportionately, it suggests they might be taking future share from rivals and locking customers into the Microsoft stack. That's a competitive disadvantage for AMZN and GOGL in that specific high-growth area.
Okay, so it's about winning the most strategic deals. That makes sense. Moving on, the second group facing headwinds. Companies with an on-premise or legacy tilt. Hewlett-Packard Enterprise, HPE, and Cisco Systems, CSCO, are listed here.
Yeah, this is more about the architectural shift. As more and more workloads move to managed cloud services, especially for things like AI, well, that naturally puts a drag on spending for traditional on-premise tech. If a company chooses Azure for its new AI database instead of buying more servers for its own data center from, say, HPE or networking gear from Cisco for that data center, that's a direct trade-off. It's just the reality of where computing is moving.
So the faster Microsoft builds its cloud, the tougher the market potentially gets for these companies in their traditional areas.
That's the basic dynamic, yes. The center of gravity for compute is shifting.
And the final category is productivity challengers. This seems to be about software competition, naming Zoom Video Communications, ZM, and DocuSign, DOCU.
This is probably the most straightforward competitive pressure. These companies offer great standalone tools, right? Zoom for video, DocuSign for signatures. But they face huge pressure from Microsoft bundling similar features into Microsoft 365, especially now with Copilot being integrated. Microsoft is adding AI features that directly overlap with what these challengers offer.
Can you give an example of how that plays out?
Sure. Take Zoom. If Copilot within Microsoft Teams can already summarize meetings and track action items pretty well, then maybe an enterprise customer thinks twice about paying separately for Zoom, even if Zoom has some better features. Or for DocuSign. If Microsoft builds decent AI-powered document creation and e-signature tools right into Word or Outlook, that creates risk for DocuSign because the functionality starts to overlap. Large companies often prefer the good enough solution that's already part of the platform they pay for. One price, simpler management.
Right, the bundling power is significant in enterprise deals. Okay, this gives us a pretty clear map. The Microsoft results show AI and cloud adoption are definitely strong.
Yeah, the demand is clearly there. But the big takeaway, I think, is how the market's view is evolving. It's not just about celebrating growth anymore. Investors are really scrutinizing the efficiency, the enormous cost needed to get that growth. It's becoming a balancing act, weighing that record spending against the future profits it's supposed to generate.
That does set up a key question going forward, doesn't it? If Microsoft keeps spending at these record levels because demand stays ahead of capacity, we have to wonder, how long did that imbalance need to last before the market starts to view that high spending more positively, as a necessary investment rather than just a cost drag?
Exactly. Finding that point where the perception shifts, that'll be a really important moment for Microsoft and all the other companies we've talked about today.
We must remind you that this discussion is for informational purposes only. This is not financial advice, nor is it a recommendation to buy or sell any security. All opinions expressed regarding winners and losers are purely those of the author of the original material.